Join us now to discuss the geopolitics at play is Roger Diwan, Vice President for Energy and Financial Markets at IHS Markit. He wrote a piece this morning. Russia, Saudi Arabia, and the U.S. shale industry enter a low-cost producer death match. And there was already a glut. And you add in the coronavirus, and this is what happens.
Correct. So what we're seeing here is a big destruction of demand. We saw it in the first quarter in China, and now we're going to see it in Europe and the United States. And on top of it, now you have a supply shock where all the producers are pumping up. So we're going to see a very large surplus. So prices obviously are reacting. What's happening is we need to pay people to store oil, which means that the front end of the curve, the oil prices are going to really continue to go down. I don't think this is the end of it today.
Your first point is a crash of historic proportions. So we don't need to worry about saying that. It's happened, and you don't need to sugarcoat it at all.
No, there's no reason to sugarcoat it. What we are about to see is basically a collapse in demand and very possible to force a deal if possible.
You have a. I mean, you're maintaining your sense of humor to some extent in this piece this morning. Will we ever see each other again? Will the merry band the Saudis and the Russians are going to need some time apart, and there's just no way this unceremonious divorce happens anytime soon, because they have totally different future viewpoints about where oil should be. And Russia needs it for their own current account deficit, and nothing's going to change about that. So this is, how long are you saying this is going to go on where they cannot agree on something? A year?
Well, I think you need a catalyst at one point to bring it. One is low prices, two, but you need to have some visibility on demand, and we don't have any visibility on demand. So it's going to take some time, and in a way what you will need is low oil prices to cure some of the problem by removing supply, correct? So you're going to see lower production in the United States and other areas, and that will be part of the solution. So I think here for at least a quarter, we're unlikely to see a solution. The problem, though, the longer you wait to bring back diplomacy, the more you build storage, you stock building oil, the longer it takes to rebalance the market.
I mean, so this is all about shale. I mean, a lot of Russia really. That hurt them badly, our production here in this country, and they would like to keep that to a minimum, and it will be at a minimum if we're down at $30, right? Shale growth?
Correct. Shale will go into a negative territory this year, and next year into prices sub 40 or around in the 40s will mean that we will lose 1 million, 1.5 million, maybe more in the United States over the next 18 months. So we'll see the U.S. Sector shrink. That would make room for the two other large producers. In many ways, this is a story of the last 3 years where the U.S. grew so fast, took market share away from OPEC, away from Russia, and that's the revenge.
Amazing.
From North Dakota?
What
shuts down?
Well, everything in the United States shrink. The Permian will do a little bit better, but everything is going to go into negative territory. We're going to see declines everywhere. We have steep decline rates in the United States, so when you start spending, you stop drilling, as we will see immediately now. We'll start to see production turning over. Amazing. Probably as early as the second quarter.